wanted to talk a little bit about sort of the AI bubble narrative. And as you see on the left here, the percentage of articles and people mentioning AI in the news or AI bubble in the news has certainly climbed over the last couple of weeks. We have seen these sort of spikes in the AI bubble narrative over the past couple of years. What I did here in that yellow box is just said, okay, if you invested at sort of the peak of the AI bubble talk back in January 2024, how would you have done? And I know it's hard to see off to the right here, but the S&P is up about 40% since the last time we saw this sort of peak AI bubble concern. It tells you that even if we are in a bubble and people are talking about it, doesn't mean there isn't still potential upside in markets. And the Mag 7 segment is up almost 100% since January 2024. And Goldman has a basket of sort of the leading AI beneficiaries, which are up over 300%. So there's an incredible amount of investment that's gone on and a lot of money that's been made despite some of these bubble concerns that we've seen pop up. And on the next page, I wanted to outline what does this sort of AI infrastructure ecosystem look like? And what fuels it is really the demand for compute. And it's largely coming from AI, but it's also coming from enterprises moving to the cloud and the growth of the digital economy. So these are big secular growth stories that are fueling the revenue growth for the hyperscalers. And the hyperscalers are the biggest spenders in the AI ecosystem. As long as they're seeing 20, 25% year-over-year growth in their cloud businesses, they're probably going to continue to invest to build out the infrastructure to support that compute demand. These companies also have healthy and really strong core businesses that generate a lot of free cash flow, allows them to use that free cash flow for investment as opposed to using their own balance sheets. That's a little different than what we've seen in past investment bubbles. But I also think it's something to keep an eye on because growth rates in the CapEx, they've been remarkable over the past several quarters, growing 50 to 70% year over year. Those growth rates are likely to normalize in the coming quarters, closer to say 20 to 25%, still growing at a pretty remarkable rate. And I think that tells you that there's probably still a lot of spending to come, but that spending is going to be predicated on the macro environment remaining healthy because a lot of these hyperscalers, their core businesses are still sensitive to the overall macro environment. The last thing I'd say is that the leading AI companies, the open AIs of the world, say that the path to getting broader AI adoption is going to come from more advanced AI models. And to get more advanced AI models, you need massive amounts of compute. And so it is kind of an interesting circular system that's in place, but it continues to drive equity markets. A lot of these resources for compute are capacity constrained. And the outsized investment continues to be well received by investors. Like any investment boom, this will fade and we'll have to sort of square the ultimate ROI and monetization for all this investment down the road. But for the meantime, it looks set to continue. And on the next page, we have a look at the state of AI adoption. There aren't a ton of ways to measure this, but one way you can do it is looking at the percentage of companies that are paying for AI models. It doesn't tell you that they're using AI to drive productivity or find cost savings, but it does tell you that a lot of companies are exploring ways to integrate AI into their businesses. As you can see on both of these charts, the adoption rate in terms of companies paying for AI models continues to increase, and it's encouraging to see. It's pretty broad-based. A lot of it's coming from technology and the financial industry, which are two sort of technology-forward industries. And I thought it was interesting yesterday, Jamie Dimon said, for the $2 billion of it that they're spending on AI R&D, they've already seen $2 billion worth of cost savings. So there haven't been a ton of tangible evidence yet that AI is going to drive productivity and cost savings. But I think we are starting to see some signs that the adoption is starting to make its way into the large corporations in the country. On the next page, I wanted to just quickly touch on the next 5 years and what that looks like for compute demand and CapEx. And we're expected to see compute demand basically grow 22% annually over the next 5 years. And the vast majority of that's coming from AI compute, expected to triple over the next 5 years. It's why we're seeing so much CapEx. If this compute demand continues to grow at such a healthy rate, it leaves the hyperscalers sort of capacity constrained, and it's why they continue to invest to build out more capacity. And McKinsey pegs it as about a $6 to $7 trillion worth of global data center investment that we're likely to see over the next 5 years. And over the last 5 years, we've seen about 1.3 trillion. So in that context, it tells us that there's potentially a lot more CapEx to come. I think even in a more modest scenario, we're likely to see more than twice the amount of CapEx we've already seen over the next 5 years. A lot of that benefits the semiconductor ecosystem, from the networking chips to the equipment to the storage chips. The question is how much of this has been priced in so far. I think a good chunk of it has been, but I think that's why on days where you see these announcements about the next sort of AI company investing, the next 10 or $100 billion, it tends to be well received by the market. This is something we talked about at the beginning of the year in our outlook call. We said, really, the biggest bottleneck in AI is in this power segment. For all the data center capacity that's coming online, there just isn't enough electricity to power these facilities. We're expected to see data center power consumption double over the next 5 years and reach about 12% of the total electricity consumed in this country. And, that's up from 2% just a few years ago. So even though it doesn't feel like it's a massive number, the amount of stress that it's putting on an already strained power grid is remarkable. And you're seeing that show up in electricity prices for consumers. They have been ticking higher. There just isn't enough power available to fund these data centers. And even though there's projected a 50 to 75 gigawatts of power coming online in the next couple of years, that's not going to be enough to support the demand. That's the growth. Data center capacity continues to outpace the supply of power. So we still think this is a really interesting place to be invested. It's where kind of the supply-demand imbalance remains challenged. And I think a lot of AI infrastructure or companies are going to have to start to invest either in behind-the-meter facilities, which means bringing your power on site, building your own power generation facilities, or partner with some of these large independent utilities to secure some long-term power. So just to close out the story on AI, we think we're still in the middle innings of the CapEx cycle. Certainly agree that there are some longer term concerns about the overinvestment and the pace of monetization. But as long as the cloud revenue growth continues to remain robust, something to keep an eye on in the coming weeks when a lot of these hyperscalers report earnings, that can still justify healthy CapEx growth and investment and fueling a lot of earnings growth for the sort of the AI beneficiaries in the market. I think on the positive side, the hyperscalers are self-funding. Haven't used a ton of their balance sheets to build out this infrastructure. The CapEx to operating cash flow has ticked to a pretty high level. So I think we're getting closer to sort of levels where these companies are going to have to start moderate the growth in the amount they spend. But really, the long-term assumptions tell us there's probably a lot more CapEx to come in the AI infrastructure ecosystem. And as this cycle ages, we just think it's paramount to be diversified, not only within the AI ecosystem, but maintain exposure outside of the AI ecosystem to areas that can offer attractive fundamentals that aren't going to be so tied to this generational theme that has had such a large impact on markets. And then just things to think about is the expectations are certainly high. There's a lot of competition that can breed inefficient capital allocation. So certainly expect probably lower than expected ROIs in the future. Closely watching the pace of monetization and adoption and comments from corporate America and large company CEOs and talking about how they're integrating AI into their business will be key to supporting all this spending going forward. And we'll touch on the valuations in a minute, but they've risen, but they're not to an extended point where you could say they've really meaningfully deviated from underlying fundamentals. And then lastly, AI as a secular theme is still not immune to the overall macro environment. So as long as that can stay healthy, we think there can be sustained momentum in the CapEx story.